Hi, Dustin back again with Dustin's Dollars. Today I'm going to talk a little bit more about AITX, compare it to Knightscope with their regarding their cash on hand, their cash burn rate, and sort of clarify a little bit about what I said yesterday about why I think AITX is has a higher risk for bankruptcy. I'll get into all that in just a minute. Before I begin for real, let me go through my disclaimer. I am not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I may own investments in some of the companies discussed in this video, and I will call it out. Specifically, I have a long position in Knightscope. I hold some preferred shares. So basically, this video should be for your entertainment only, because I could be wrong about everything I say in the video. You need to do your own research before making any investment decisions. All right, so that being said, let's get into it. First, I did want to cover real quick before I get into the meat of today's video that there was an announcement today where Knightscope made another sale to a Fortune 1000 hotel client. They sold a K5, so that was nice to see. And again, we're seeing Knightscope sell into clients that have many locations, right? They call it out here explicitly. They don't tell us who it is, but they say it's in Seattle, Washington, at the particular location they contracted at. But they say that this company has 5,400 locations in the United States. And those are the sorts of deals that make you wonder, like, well, if they need this at one of their locations and it goes well, might they want that at the other 5,399? So that is certainly part of the long-term thesis, bull thesis for Knightscope. Yeah, so I thought that was a nice bit of news today. Granted, the stock, I think I'll pull it up real quick just since I mentioned. I think the stock was down 12% today. Yeah, 12.5%. So market don't care, but I mean that's to be expected, right? One new robot sale. I know there was that we laughed. I laughed at least at that article that said, hey, that Knightscope sold a robot, and so it went up by 150% or whatever it was on that crazy day after trading. I mean, it was not because of that, right? That's we've said it's significant because it's like a 1% increase in revenue, which is nice that they can just do it like that. But it really doesn't move the needle at the moment, right? We need to see this over time, and we need to see bigger orders coming in, and all the actual profitability metrics going on there. But so let's get into it, into the meat of today. So I got this comment here. Thank you, Bailey and the Investor, for watching and for commenting and giving me your perspective. And so I wanted to highlight this here and talk about it a little bit more today, because it's a good comment. And so let me read it real quick. He says, he or she says, I got to give it to you. This is entertaining. I admit both companies have problematic financials right now, and they're both going to be diluting, but these are speculative stocks. Anyone investing in either is rolling the dice. I hope nobody invested in either is doing so based on current fundamentals. The hilariousness of stay away from AITX, but you're long a company with these numbers, and he or she quotes this, looking at financial data included in the KSCP's IPO filing, the company lost $22.7 million for the first 6 months of 2021 with a revenue of $1.8 million. In 2020, they lost $9.1 million on a revenue of $1.6 million. And they also say that AITX also has probably twice the devices active in the field. So, yeah. On the I'll sort of comment that in reverse order just real quick. I haven't actually looked deeply into their revenue and their devices. I mean, I looked at their revenue, but I haven't tried to. I'm not as dialed in there as I am for Knightscope in terms of how they're really growing there and how their deployments have been, and what potential clients they have. So I acknowledge that. Now going back, I agree with actually a lot of what you said there. That these are both very speculative stocks, and I do think they're both going to be diluting. And as I think I already mentioned earlier, I do hold some of the preferred S shares in Knightscope, and part of that is part of my investing thesis is also those have some anti-dilution clauses. So I think that's going to actually be good for folks who hold those shares. I do think Knightscope is going to have to dilute in the future, and I'll talk about that sort of as I go on in this video. But I agree. Nobody should be investing based on the current fundamentals. These are both rolling the dice. All I was seeing when I'm looking at AITX is it looks like you're rolling the dice, let's say a lot more, if you want to continue the metaphor there. And I'll get into it. But And just so we're clear, I'm not saying to stay away from AITX. I think, there's very clearly risk and reward for both companies where they are both very risky, in my opinion. Again, not trying to give any investment advice for or against either company, but I do think these are both very risky. But in my estimation, I think AITX is riskier than Knightscope. And I will get into my rationale for that. I will explain why I think that. So, first I'm going to go through Knightscope. One quick note, going back on the K5 that was announced today, that brings my estimate of their machines under contract, if they haven't actually had any churn, if they haven't lost any clients, up to 112 machines under contract, not deployed, but under contract. So if you're curious how I got to that number, you can check out my previous video about Knightscope and are they growing and how fast are they growing their revenues, I think is what I titled it. And so I went through, my methodology there. So getting into it, yeah, I do agree this is risky for both companies. And to your point, right, this is not necessarily the balance sheet, this is their income statement, right? That they are losing money. They're a money losing machine. Both of them are. And I agree. Knightscope is, you could argue might even be worse because they have negative gross margins, right? And that's so ugly right now. I have a little bit of faith that when management gives us those unit economics figures, that those are actually credible in the not so distant future. Because if those aren't, if they're going to lose money, at the basically at the top line or right beneath the top line, right, their gross margins, like, of course, the company has no future at all. The simple math at that point. But getting back to their balance sheet, right, and their this is what I really want to talk about today. And I'm pulling all this from their the most recent filing. I think this is a 1A maybe. It's part of their offering circular, right? This was filed in January 21 of 2022. Let me get back to it. And it's balanced. Actually, let me go to capital resources, right? So this is the beginning of it, where they put in a statement here that as of December 31st, 2021, our cash on hand was approximately $10 million. So, that's my starting point, that a month and a half ago or so, Knightscope had $10 million cash on hand, right? And this, as far as I understand, and I could be wrong, but I'm pretty sure this was actually before they got any money from the most recent raise, right? And so they did get like about $22 million from that. I actually calculated this out, that they sold $22.3 million. I think if you read the circular, I think they paid about 7% in fees. So they got about 20.9, let's round it off there, $1 million actually net to the company. So after that point, they should have had, approximately $30.9 million cash on hand. Let's say, between those two, between the 10 million they already had and what they got in this particular raise. So then now I'm looking, going down to their condensed balance sheet. And, the one thing to keep in mind, this is unaudited, although I'm taking it on good faith that this balance sheet, even though it's unaudited, is accurate. I mean, if we can't trust the numbers, then obviously we can't really draw, all of our conclusions will be invalid. But for now, let's assume that these are good. And so looking down here, I kind of see that they're, the receivables, prepaid expenses, right? That stuff is effectively balanced with their accounts payable, their accrued expenses they have here. Like, I didn't really add that up because they're close to one another. I kind of figured that's just their working capital. It's not huge relative to the $30 million that they had on hand. Now, they also had about $4.9 million in debt obligations here, right? So if we take that 30.9, subtract this off, figure they had about $26 million in cash January 21st, 2021, if they paid off this debt. Okay? So that's sort of my starting point. I don't worry about the operating lease liabilities. That kind of, I think, those are things they're going to have to pay in the future, but I think that basically just comes through. That's going to come through when I talk about their cash burn rate, right? Because those would be, what do they pay for their lease as part of their operating expenses. Now they do have, this looks scary, preferred stock warrant liability, and feel free to roast me in the comments if I misunderstand this. But as far as I understand this preferred stock warrant liability is not something they're going to have to pay in cash, right? This is actually something that, if I understand correctly, this is stating, they have issued warrants and to someone, and in the future, someone else can exercise those warrants, and that they will have to, Knightscope will have to give them the shares for the strike price on those warrants. And so that is effectively an obligation that the company has to give them those shares. And this liability is listed here so that things sort of, even out from an accounting standpoint for how much those warrants are worth, right? Because those warrants have value, and right now it is a liability for the company. In the future, they're going to have to give those folks those shares, presumably under fair value, and this is basically tracking the value of that warrant. But when that warrant is exercised, I'm pretty sure they're actually going to get cash rather than lose cash. So even though it's listed as a liability, and it is a real liability, right? This is effectively future dilution that's already built in. And I actually wanted to revisit this because I wanted to dig into this to maybe make an updated future float and market cap calculation. That's on my to-do list. I will get around to that at some point, because I may have missed it. I'm not 100% sure that I got this right when I tried to do that the first time around in my prior videos. But point is, this and I was also reading a little bit about these. They took away the cashless exercise on these warrants, so they are, I think, if these warrants ever get exercised, going to actually receive cash. So in terms of cash burn rate, and are they going bankrupt, and when will they have to dilute so that they can continue funding operations, I don't think this is relevant there. Again, individual investor, not a financial professional. So if somebody thinks that I got that wrong, comment and let me know. I'd love to learn. So that's where we're at. And then non-current liabilities, right? They really don't have anything that's that I figured is worth writing home about, right? Like the debt is all current year, and the preferred stock warrant liability, same deal. And then, like I say, operating lease liabilities, I figured that just comes out with the OpEx. Okay, so that's what I was looking at there. Now, if we go down to their actual income statement, or statement of operations, I guess they call it, right? And this is for the, by the way, I should mention all of these numbers were as of June 30th, 2021. I am not 100% sure because I obviously haven't read through every single filing recently, but I don't recall them issuing any more debt in the meantime. I could be wrong, right? If they actually did, then that would be a glaring hole in this, not glaring, but that would be a hole in this analysis, where if they actually issued more debt. In the meantime, I think they, that would be another thing they'd have to pay off. That would sort of just adjust my numbers downwards. But, they've been issuing equity, right? And raising so much money that I don't think they also issued debt. I know they issued those convertible shares, but I don't think any of those, dealt with cash. So let's go down here and then try to figure out, right? So if they have about, $26 million in cash as of January 1st, 2022, let's talk about what's the burn rate. And so, as I mentioned, this negative gross margins is nasty, but overall, I kind of added this up, and I'm going to go through it real quick. I'm not going to go through it real quick. I'm going to use the numbers that I already got. It looked like they are burning about $2.1 million per month if I use the first 6 months of 2021 as the sort of the baseline. And I think it's fairly accurate. They have had a couple job postings over time, but hasn't looked to me. I do keep tabs on that too a little bit. I don't think they've been filling those too fast. And then honestly, if you look at where most of their money is being spent, the big thing that stands out to me is the sales and marketing, and I'm gonna talk about that in just a second. But basically, it looks like about $2.1 million in actual cash expenses on average per month over these 6 months. So if we take that, right, and we look at this $26 million and divide it by that $2.1 million, that gives us about 12 months of runway, right, that they can fund operations without having to issue anything. They've already got the cash in hand, right? They already have about that $26 million in kind of net cash as of January 21st. So, I think for Knightscope, we are looking at all of 2022 where they can fund operations. So that's not that long, right? In terms of a business, 1 year until they, might go bankrupt or are going to basically have to dilute, that's scary. That's not good. But, they at least have some cash on hand, right? They have options. They have some runway at the current moment. I also think one thing that I wanted to highlight here is if you look at that $1.1 million per month was their sales and marketing expense. And there was an interesting comment from the this is on the Start Engine Knightscope page that folks have asked a couple questions, and Bill William, the CEO, has responded to. And one of them I wanted to call is right here. Let's see if I can zoom this in. Maybe you can read it. Hopefully that's big enough for you to read. So here we go. Thought it lost it. So someone asked about how much they're spending on advertising. And, Bill says basically, the ads are useful for us because we basically get, we grow in 4 different ways from the ads, right? We build the brand. We, more people know about us, so we get actually recruits, right? New employees, people applying for jobs. We raise awareness with clients, and so we get new clients from that. And then they also get investors, right? And you mentioned all 4 of those. But, when they were fundraising, I think the big thing was investors, right? This is sort of my theory, and I might talk about this a little more in a future video in terms of, sort of a bit of, this is again, pure speculation, but a bit of what I think their mentality was when they were raising to retail. And I think this was a calculated decision that they treated this like, a lot of companies would treat advertising. It's just, in this case, the person they're advertising to is somebody who's, is the investors rather than the clients. And, I think it worked reasonably well for them, right? They kept doing it even into this most recent round. And so, I think those expenses, what they were spending on advertising was very calculated to raise even more money back to the company in terms of people investing. Anyways, going on with this, he says, but now that we have a good critical mass and some higher visibility from the public listing, personally wanting to spend on building up the sales team itself and to continuing with the Robot Roadshow nationwide as our best bets at this time to put the capital to work. So this is me speculating quite a bit, but I'm wondering if that $6.6 million, which I think is called out elsewhere in the filing here, right? That's actually largely advertising expenses. Where's it at? Look at this. Where is it at? Oh, I'm losing it. Yeah, and so this is where I got this. They're saying, hey, the advertising expense this one was for the year, $4.9 million for the year ended December 31st, 2020. And so if we go back to the sheet, so we go to this one and we go up to that year. Right, I just said I think 4.9 million. You can see there. Oh, that's not it. Oh man. Oh well. Anyways, the point is, I did the math earlier. I was hoping to show you rather than just tell you, but it was about 67% of their sales and marketing. So if they're not fundraising, this is again pure speculation. They might, they could potentially knock off 67% of that, right? 2/3 of this expense. Obviously they're still probably going to have some advertising to get sales, but I think if he's saying, hey, I'd rather put this money into my direct sales staff, we might see that sales and marketing expense go down. And so this is just me, making up numbers, but if instead of, spending $1.1 million per month on sales and marketing, if they actually just, got that down, save it by $500,000 a month, and so they're still spending $600,000 a month on sales and marketing rather than the 1.1. That would take our $26 million that we previously had, and then cut our monthly cash burn rate, Knightscope's monthly cash burn rate, down to $1.6 million per month, and give you 16 months of runway, right? And so that might be I'm not gonna say painless, but a less painful way to extend that run rate out for them. All right, so I talked about Knightscope. That's where they're at. Now I want to go to AITX, right? And so let's go here, right? So AITX, they have $4.1 million of cash on hand at the end of November of 2021, right? So they, are filing quarterly, so we have more recent numbers from them. they have this a couple of these additional receivables, including this, share proceeds receivable. But you add that up, it's about what's that, $1.7 million here, in sort of not direct cash, but other assets they have listed here. I'm not counting their inventory as a cash asset, as I mentioned yesterday. And so if we go down here, they have payables that are roughly offsetting that 1.7 million here. So I figure that's kind of a wash, and so I call it $4.1 million of cash. So 4.1 million. That's okay, I guess. Now this is where it gets more ugly, right? You have all of these current liabilities. This is $500,000 here, $500,000 for these are lease liability, variable, deferred payments, basically, that they are going to have to make because they've deferred them. Compensation plan that they have to pay to somebody, loans, and then here's the current portion of loans payable. This is the real big one, and then this is the second actual part here that's big, is the accrued interest payable, right? And so these are big numbers, right? So I add up these current liabilities. Again, this is what they, if I understand correctly, again, not an accountant or financial professional, but I'm pretty sure this is what they are going to have to pay off, or are expecting to have to pay off in the upcoming 12 months. You add those up, and this is about $5.4 million. So right off the bat, they have $4.1 million of cash. Some of those other smaller things, both on the assets and the liabilities, payables and receivables, etc., they sort of offset each other. I'm just sort of calling those a wash, sort of like I did for Knightscope. But you have $4.1 million of cash that is mismatched with a $5.4 million of liabilities upcoming in the next year. So that already is scary for a company that's not profitable. But then long-term debt, right? And again, I'm not worrying about the leases the same way I did for Knightscope. I kind of ignore that. It comes out in the actual cash burn rate, because usually those tend to be long-term, right? But this is it, right? The loans payable, where they have almost $13 million of additional loans that they owe, debt, and then they have another $2.5 million in debt, and then another $1.5 million in accrued interest that they're going to have to pay, post the next 12 months. And when you add all that up, that's another, if I did it right, $16.9 million that they owe, right? This is where the big imbalance is, why I think AITX is a lot closer to bankruptcy than Knightscope, because this is a big imbalance between their cash position and all of their liabilities that they're going to have to pay in not that long. And so I try to also look forward a little bit, right, like I did with Knightscope. We do know that on December 26th, they I'm jumping ahead of myself. So let's also talk about what is their burn rate. And I use this 9 months ended November 30th, 2021 to estimate this, right? And so they're making about 1.1 million of revenue, but that ends up getting them about 800,000 in actual gross profit. But then their OPEX here is $11 million. So, and the rest of it, and then they also have that interest expense, right? Which is kind of already taken care of up there. But I think if I just looked at this, I calculated out, and we are excluding those interest payments, right? It's about they're losing about $1.1 million per month, right? And so if they had $4.1 million at the beginning or at the end of November, and they're losing $1.1 million per month on top of having, liabilities that are already taking away from that 4.1 million, like that would be like just straight line. They'd run out of money in 4 months, forgetting even about the liabilities because they're losing 1.1 million per month. But then when you add in those liabilities, like it's even harder, right? If I include even just these interest payments, on average, just this. And again, I don't care about the change in fair value of derivative liabilities. In fact, theirs is a net benefit to the company because their value, it keeps going down. And I think Knightscope will see that, right? If their stock price is actually under $10 by the time they file their next quarterly, or semi-annual, whatever it is that they'll file next for an actual like 10Q or 10K, or if they do one of their weird semi-annual ones now, whatever that ends up being. But when they file those, right, I think we'll actually see a net benefit to the company in terms of what their liabilities are stated as. Again, I think it's sort of I understand why they do it for accounting. It's not really relevant, I think, for calculating cash burn rates and such. But the point is, if I include this interest expense, right, that actually brings their monthly cash burn rate up to $1.7 million. So now they're closer, from out of the $4.1 million in cash, instead of running out in like 4 months, they're running out in like 3 months. That's what's most scary about AITX, right? It's like single digits, like 3 or 4 months away from bankruptcy, and I'm not sure that they could issue very much more debt because they already owe, what did I say, like $20 million, something like that, in total liabilities. That's Knightscope has a cleaner balance sheet because, if they need to issue some debt, they might be able to, right? Because they don't have a whole lot of, debt already on there that folks are already basically, at the top line of the company and first in line in case they do go bankrupt, right? People are more apt to, I think banks are more apt to lend to them if they, if they're getting in basically as the first people in line if they do go bankrupt. But if there's already a lot of other debtors there, like, forget it. So that's why I think AITX is riskier. And I know they have been diluting, right? We talked about this last time where they already, let's even talk about that dilution. They've got this agreement. They can raise some cash, that purchase agreement with, I think it was GHS in here. Yeah. So it's right there. Oops. Why does it do that? But they've already even issued, right? You can look at this. They already issued 100 million shares for net proceeds of $1.1 million, 1.2, let's round it up. And yeah, so like they've already issued 1/4 of this. They got $1.1 million. So basically, if they do the same thing up to that total 400 million shares that they agreed that they would purchase, and they get about the same amount, even though I would expect them to get less since the share price is, I think, just trickled down a little bit since then. But let's assume that it's the same as what it is here. Every time they do that, they're basically, at the prior burn rate that we see, buying about, at best, let's say 1 month's worth of operations for the company, right? So if they had cash for about 4 months, they can do this 3 more times and get about 7 months worth. And that's with the starting time of the end of November, right? So 7 months from the end of November actually just puts us at the end of June next year. So that's really only, end of June this year, because that was November of last year. So we're talking maybe 4 or 5 more months. That's what scares me about AITX when I look at it. And again, this is no judgment on the products, no judgment on no judgment on how they've been growing and what the prospects are for the company. Like, that may be true, but just financially, when I'm looking at the balance sheet, this scares me away. It scares me away that, like, it's not obvious to me what growth story you could have unless you tell me they've just signed a deal for, it's going to guarantee them tens of millions of dollars in revenue with good margins. Like, that's what it would take, I think, very quickly to start getting this company out of the hole, right? To dig out of the hole, or whatever metaphor you want to use. I mean, this is it's pretty serious, I think. And one other note here is just in terms of total shares out that they have even authorized, they have 5 billion shares authorized. They've at this point, right at the end of November, they had issued 4.4. They've issued another 100 million since then. So they only have half a billion more shares they can issue. Period. And they already have a purchase agreement for, with that GHS for another 300 million. So they're very quickly even running up to the limit of what they have authorized. And that might also be a problem for them. So yeah, that is what I wanted to cover today. Hopefully that explains. I know that was maybe a bit long, but hopefully that explains why, in more detail, why I think AITX is even higher risk than Knightscope at this point. I mean, again, I do agree. Both are very risky, and in my opinion, not giving financial advice, both are very risky and speculative companies. And I think, the market opportunity is there for either company. But the financials on AITX just look a lot scarier to me, a lot riskier to me. And, hopefully I've explained why. Feel free to, disagree in the comments, or, ask me more questions if something I said, doesn't make sense. Or if I got something wrong, let me know. I'm like I said, I'm an individual investor, not a professional. And I'd love to learn if I got something wrong. So, all right. Thank you.